Welcome to The Explainer. We're diving right into a completely unexpected, frankly fascinating showdown unfolding right now in the 2026 financial markets. Picture this. On one side, you've got these unstoppable, hyper-complex modern AI algorithms that have basically been running the trading world. And on the other side, a dusty, classical, value investing rulebook written way back in the 1940s. It sounds crazy, but the results of this collision are literally rewriting how we think about risk and reward.
I mean, it sounds like a totally unfair fight, doesn't it? Can a set of basic pen and paper fundamental rules genuinely outsmart unrestricted, state-of-the-art machine learning models? We're talking supercomputers processing millions of data points a second. This exact question sets up a massive old versus new narrative that we're going to unpack today. We'll be pulling from fresh market data, checking in on the ultimate value investors over at Berkshire Hathaway, and digging into a groundbreaking new academic study.
Okay, let's dive into this. Here is our roadmap for today. First, the great market rotation. Second, Berkshire's post-Buffett playbook. Then, AI meets Benjamin Graham, followed by why the algorithm failed, and finally, the timeless value edge. All right, section 1, the great market rotation. Tech stumbles, small caps surge.
So, looking at the latest Morningstar data, there is a massive shift taking place in the markets. After that absolute monster surge of the AI investment boom back in 2025, well, the script has completely flipped. The technology sector is actually sitting in the red right now, down 0.40%. Meanwhile, money is just pouring into real assets. Basic materials are up over 9%. Industrials are right behind at 8.51%, and energy is up over 6%. Investors are clearly rotating away from all that tech hype and anchoring back into tangible, structural value.
And because of this, we're witnessing a classic David versus Goliath moment. Small cap companies are surging ahead, up 5.57% for the year, while the large cap giants, the Magnificent Seven, they're barely moving, up just 0.5%. So what's driving this? Honestly, it's just fundamentals. Analysts are pointing out that small caps and non-tech companies are finally closing that earnings gap, and they're getting a massive boost from lower interest rates and a surprisingly strong macroeconomic environment. The market is suddenly deciding to reward actual fundamental earnings over AI promises.
Moving on to Section 2, Berkshire's post-Buffett playbook. The smart money plays it safe. Now this number is just staggering. $370 billion. In his very first annual letter since Warren Buffett stepped down as CEO, Greg Abel revealed that Berkshire's cash and U.S. Treasury holdings have hit an absolute record high. To put that into perspective, their cash and Treasury hoard has officially surpassed their stock market value for the first time ever. That pushes their equity portfolio below 50% of total assets. Berkshire is proactively and aggressively playing it safe because they're anticipating a potential market peak.
In that exact same letter, Abel reiterated a classic Buffett philosophy. He compared investing to the legendary baseball player Ted Williams. You see, Williams divided his strike zone into 77 distinct areas and chose to swing only at pitches in his absolute sweet spot. The crucial takeaway here is discipline. Berkshire isn't abandoning the market. No, they're just letting the power of compounding work on their massive cash pile while they patiently wait for the perfect fundamental setup. They are completely avoiding the temptation to chase overvalued hype.
Which brings us to Section 3, AI meets Benjamin Graham, the ultimate cage match.
So researchers recently set up a pristine and frankly brilliant experiment. In one corner, they encoded Benjamin Graham's strict 1940s fundamental rulebook. We're talking 7 rigid defensive criteria demanding things like rock-solid liquidity and a price-to-earnings ratio strictly under 15. In the other corner, they unleashed unrestricted, state-of-the-art machine learning models like XGBoost and AutoGluon. These AI models were programmed to hunt for modern quantitative factors, constantly chasing 30-day volatility and short-term momentum. They ran this epic clash of ideologies through a rigorous 20-year simulation on the S&P 500. But here's the most critical part of the study. They included a strict 4-year out-of-sample test window from March 2022 to March 2026. Why does that matter? Because this specific window perfectly captures a severe macroeconomic crash followed by a market rally. It's the ultimate crucible. It shows us which model actually survives real-world market shocks and which one basically just memorized the previous bull market and thought it was a genius.
And the results? Well, let's look at Section 4, why the algorithm failed. The danger of chasing hype.
Now, what's really interesting here is the blue line charting the highest path. That represents the pure 1940s Graham algorithm. It achieved the highest total return of the entire simulation at a massive 232.13%, thoroughly crushing the S&P 500 benchmark. It didn't just survive the modern AI, it flat out beat it in absolute returns. But to truly understand why the AI lost, you have to look at the drawdowns. The unrestricted auto-gluon model, that's the purple line, suffered a catastrophic 39.78% crash during the 2022 market shock. Why did that happen? Because the AI drifted. Without strict fundamental rules to anchor it, the AI naturally defaulted to chasing high volatility, hypergrowth tech stocks right before inflation and interest rates spiked. It prioritized short-term momentum over structural safety.
The stats lay it out perfectly. The pure Graham AI achieved a 232% return with a CalMAR ratio of 1.38. Simply put, it generated massive returns for every single unit of risk it took. On the flip side, the unrestricted auto-gluon model fell short on returns at 222%, but with a much lower CalMAR ratio of 1.16 because it took on catastrophic risk. The researchers actually proved this mathematically. When an AI is forced to use Graham's classical rules, it generates statistically significant alpha while dodging the pitfalls. Without those rules, the AI's returns are mathematically indistinguishable from random market noise. No way around it.
This brings us to our final stop, Section 5, the timeless value edge, fundamentals over hype.
The researchers beautifully described Graham's rules as a mathematical low-pass filter. Now, in engineering, a low-pass filter removes high-frequency noise. In finance, Graham's rules act exactly the same way. They mathematically filter out short-term market hype and financially fragile companies. So, while the AI was out there wildly buying volatile tech companies with weak balance sheets, the Graham model was safely compounding capital in cash-rich, heavy industrial companies that could easily shrug off interest rate hikes. Structural safety proved, beyond a shadow of a doubt, to be a superior tool for asset allocation.
So let's bring all of this together into three key takeaways. First, the 2026 market is actively rotating away from tech hype and plunging right into tangible value and small cap earnings. Second, the smartest money in the room, Berkshire Hathaway, is sitting on a record $370 billion in cash, patiently waiting for fundamentally sound, sweet spot opportunities rather than just chasing the latest momentum. And third, academic research mathematically proves that Benjamin Graham's classical rules are the ultimate defense. They prevent even the most advanced AI from destroying a portfolio with market noise.
Which leaves us with this final thought to chew on. We are constantly told that the future belongs entirely to complex algorithms and artificial intelligence, but the data shows that without the anchor of fundamental economic reality, those algorithms fail. In a market totally dominated by AI and hype, the ultimate edge might just be the timeless 1940s wisdom of a margin of safety. So, is your portfolio protected by one? Think about it.